Turn up the volume on the little flying lizards. How can anything go wrong? In just a minute, I'm going to be visiting with Aaron Dunn. We're going to talk about the search for yield, but I'm going to start with something he said at last year's World Outlook Conference. But first, time now for this week's quote of the week. I go on about this, and last week specifically, I mentioned the constant attacks on free speech and really troubling on university campuses. I mean, way too often views that are not part of the progressive agenda are unwelcome, which brings me to a statement by former university president of St. John's College, John Agresto, who asks in quotes, "Why would any student spend tens of thousands of dollars and, rather than see the world in all its aspects, instead spend his time being indoctrinated and immersed in the prejudices of the current culture and the opinions of his tendentious professors? The job of teachers is to liberate minds, not capture them." End of quote. Sometimes I wish I read those a little more clearly, but my goodness, I think that's a really interesting observation. Why would any student spend tens of thousands of dollars and rather see the world in all its aspects, instead spend his or her time being indoctrinated and immersed in the prejudice of the current culture and the opinions of tendentious professors? I agree. The job of teachers is to liberate minds, not capture them. We are way off track in that regard. Let's bring on Aaron Dunn, Keystone Financial. You can find him at www.keystocks.com. Aaron, first of all, I look forward to, you're going to be with me again at the World Outlook Conference. We're doing something very special this year. Haven't done it before. This problem with getting yield, getting something above your 1% at the bank, or you're looking at 10-year bonds at 2%, it's been a challenge for several years now, so we're going to do a special breakout session on that starting 1 o'clock Friday, February 3rd. But that brings me to this. You were there last year, and I got to talk about a little company that you recommended because it's everything we like to accomplish at the World Outlook Conference. You talked to me about, and the whole group, by the way, Exchange Income Corp, and I had a look at it on Friday. My goodness, that's what I call performing.
Yeah, the company is up. The share price is up since the conference, 65%, but it also was paying a 7% yield at the time. So investors are basically getting a return of greater than 70%. And what I loved about Exchange is that I was using it basically as an example of the type of company that we like to recommend. It's not something you can easily categorize into a particular industry, but it just had a lot of visible growth on the horizon, things that it was doing organically through acquisitions, and it was paying a nice yield. It was growing that yield. The valuation was good, and we had a lot of confidence in the management team. So it's great to be able to take those companies and use them as examples of what we look for when we're making recommendations. And it's even greater when we do that and the company goes up 70% and pays a really fat yield at the same time.
Well, yeah, I mean, absolutely. From our point of view, we have Ryan Irving was speaking on the main stage from Keystone Financial, and Ryan and Aaron and their team present the small cap portfolio every year for our World Outlook Conference attendees. Well, it's up 30% this past year. But we've got other things. It's not just that. We got John Johnston last year gave us absolutely the blueprint for what was happening with the Canadian dollar. Joseph Schachter's picks on the oil side were up over 300% on average. And I don't have to say much more about Martin Armstrong. Mark Leavitt on precious metals. So that's what we try and do there at the World Outlook, is actually make this stuff pay. And that's why I get excited, Aaron, when I see stuff like the Exchange Income Fund and I see the kind of stuff that it's produced. But it's a fantastic call. You're going to be there again, talking about the search for yield. So let me ask you this. Is it a tougher environment this year than last year, given we've seen the states start raising interest rates?
I think that the environment is fairly comparable, and it changes a lot. It changes a lot. You find that investor sentiment goes from positive to negative with income stocks, and one of the things that can actually send share prices down just in the very near term is expectations that interest rates are going to increase, because people see interest rates as being an alternative. The bond market as being an alternative to dividend stocks. We understand that mentality, and to an extent it's true, but we think that it's very much overblown, the way that the market reacts when they think that interest rates are gonna continue to increase. And we've seen the cycle happen about 4 times over the past 5 years, where interest rates start going up. All of the pundits on the news say this is it. We're going to start seeing interest rates continue to rise to to historical norms, and what that results in a lot of the time is a lot of these stable dividend growth stocks moving down in price just in the short term. But what we've found over these cycles is that the pundits have not been correct. That we're at a very low rate of interest rates right now at bond yields, and that makes it very easy for anything to cause them to bounce off of those bottoms and make it look like they're moving up, and that they're going to continue to move up. But what it does provide to investors is an opportunity to look at quality companies that will move down in price somewhat because of these fears, and they can buy these companies and they can hold them long term, and that has been the way to make money over the past 5 years, is not to just follow the market, but to have an independent mind and to look at the companies that you're buying and to understand what the fundamentals are and what is going to allow them to grow over time. And if you can do that, and you can take a mid to a long-term approach, you can look at an investment as something that you're going to hold for 1 to 3 years or 2 to 5 years, and not just what it's going to do over the next 6 months. If you can do that, then you can add these high-quality companies at reasonable prices into your portfolio, high-quality dividend growth stocks, and hold them, and you end up doing really well if you can exercise that discipline and that mentality.
Well, even me asking you, as the environment changed, I immediately think to myself, well, no, because a year ago, December 2015, we had the Federal Reserve saying the same stuff, that they raised rates in December 2015 and said we got another, I think, 3 coming, and of course that never manifested. So flash forward to this December, they're saying the same thing. So it's not just the analysts, it's the head of the Federal Reserve who's kind of had this one wrong. But it is interesting, your point is that the market reacts and it discounts those future rises almost immediately.
Yeah, and it assumes that those increases are going to continue. Like I said before, if you were to look at a chart of bond yields and interest rates going over the past 10, 20 years, you would see how ridiculously low rates are right now. And even the uptick in rates that we've seen since Trump was elected, I mean, it's like a speck on that graph. So really, where interest rates are right now, I think it would be perfectly healthy if we had an economic environment where rates were to rise somewhat off of these levels. But they could rise quite a bit from here, and they would still be extremely low on a historical basis. And I think that's what the market really has to take into account. We could have the Fed move rates up 2-3 times over the next, say, 18 months or year or whatever it is, and you're still going to have extremely low rates, and you're still going to have a bond market that doesn't provide that much of a return. But our strategy as well is that, and what we always exercise is that we are not trying to predict the future. I'm not trying to say where interest rates are going to be in 1 year or 2 years or 3 years. Nobody can tell you that. But one way that we do mitigate the risk of rising interest rates is through growth, is because we're not just looking for companies that are paying a yield, but we're looking for companies that are paying a yield, that are reinvesting cash flow back into the business, that are growing their earnings and cash flow per share, and they're able to increase that yield over time. So if you're looking at a reasonable time horizon and you're investing in these dividend growth stocks, and we think that they're going to continue to do well, even if interest rates and bond yields continue to rise from this level.
Is there a challenge? Because I'm thinking about this. I mean, obviously, some of the stocks you follow are massive. You've recommended the banks, over the years, that kind of stuff, and obviously there's tons of liquidity. But is there a challenge because there's so many people? I mean, it doesn't matter what category you put yourself in. There's some portion of your portfolio, maybe a huge portion, maybe a small portion, that needs quality kind of companies that pay a dividend. I mean, that's been my number one recommendation, literally, and I'm proud to say, since March 2009, that's what we've been talking about on Money Talks, and that was the low in the markets. But that's been our theme on Money Talks. Get quality dividend payers. Not that, I mean, gosh, look at the track record that Keystone has getting small caps. And I mean, that's why I feature some of the work you do on that score, because I believe in it. But I'm just saying, for everyone can have room for quality dividend payers in their portfolio. And I'm just wondering, because of that, is it tougher to find them now? I mean, I'm talking about share size, that kind of stuff. Everyone's looking for the same thing.
It's never easy to find great investments. I mean, these opportunities, they're not just low-laying fruit, and that's the reason why we look at everything, and we're doing research every day, and we're talking to companies and reviewing management discussion and analysis, financial statements and whatnot. So it's never easy, but you are able to find those gems. And sometimes it's not a matter where it's just an obviously cheap or inexpensive valuation. Warren Buffett said once that he would rather buy a great company at a reasonable price than a bad company at a great price. So you can pay a higher valuation, but in terms of comparing that valuation, what's important is that you compare that valuation to the growth profile and the quality of the company. And even if you're paying a valuation which is, say, at the market average or a little over the market average, if you're getting a company that is far better than the market average, then that could be a good investment. So we do see these opportunities, and they're not easy to find, but sometimes it's a matter of being patient. You can find a company that is growing and the share price is growing, and then all of a sudden the market decides to become disinterested in it for a variety of reasons, and the financial performance continues to be strong, but the share price just kind of treads water for a little while, and as the earnings grow and the share price doesn't, then the value comes back, and then that becomes that's an opportunity to buy right there. So it really just comes down to diligent research and understanding the businesses and looking at everything, just looking at everything.
You know, it's funny. I was just sitting here thinking that one of the challenges in your business and having, and Keystone has a fabulous track record on the small cap, and I love the work you do on the yield side of things, as I said, because I think it's appropriate for everybody to have a look at that. But one of the things, it's always a what have you done for me lately kind of business. You know, like you do Exchange Income Fund and you're going, yeah, we're up 65% since we recommended it at last year's World Outlook Conference. And people go, yeah, that's great. What about now? And,
so you're saying I can't sit back for the next 2 years and talk about Exchange and how well it is.
That's what I mean, you know. So are you going to have some other recommendations for us at the World Outlook?
Yeah, absolutely. We're going to have a portfolio of quality companies at the Outlook. This Outlook particularly is exciting for myself and for Ryan because he's going to be there, like you said, doing a small cap portfolio. This is the first time we're both going to be doing a keynote presentation. So between the two of us, the attendees at the event are going to have solid picks of high growth small cap companies and dividend growth stocks. And what we always say to investors is you start your portfolio with a core of high quality dividend growth stocks, and then you can augment that return by adding some higher risk, higher growth companies as well. And that's basically what we're going to be doing. But yeah, I've got several companies that I'm looking at right now and some really interesting picks, things that are paying nice yields today and that are growing those dividends over time. So we're really excited about this event and what we're able to do for the attendees there.
Got to take a break, come back. I've got Aaron Dunn on the line with me. You can find them at keystocks.com, keystocks.com, but come and meet them in person at the World Outlook Conference, February 3rd and February 4th. Back in a moment, we got much more. I got a great shocking stat. And by the way, this Goofy Award, this is destination living, because either you're going to hate it or you're going to think, thank God someone finally said it. I'll do that before we're done here today on the Money Talks Network. Coming up, Ozzie Jurek is issuing a sell recommendation on a specific type of real estate. He's going to give us the specifics right after the shocking stat. Excuse me. But right now I've got Aaron Dunn on the line with me, Keystone Financial. Aaron, I want to come back to something we were just chatting about. We talked about the Exchange Income Fund recommendation last year at the World Outlook, up 65%, 7% dividend. Now, has that become a sell recommendation because of the price rise? Do you still like it? How do we handle a stock like that? Hey, we're thrilled, we get a winner, but how do we handle it at this point?
So the way that we look at it is we look at how has the valuation changed and how has the outlook changed from when it started to increase to today. So relative to cash flow, the valuation still is quite attractive. Even though the company has increased in price by about 65%, over the past 18 months, free cash flow per share has actually it's more than doubled. So from a valuation perspective, it's a company that's still looking good. And then we look as well at future outlook. Is that growth going to continue? In the case of a company like Exchange, we're not expecting to see the same level of growth over the next year just because the acquisition market, the nature of the acquisition market is opportunities just, they come and they go, so they're impossible at the time. But what it does have going for it right now that a lot of other companies don't have is it has a very strong organic growth profile. So organically, they've been growing in the high single, low double digits, and we're expecting that to continue. They'll probably very likely do, one or two small acquisitions over the next 12 months potentially. So, you're looking at a company now. It still has a growth profile. It has good organic growth. It's trading an attractive valuation, pays that nice yield, is growing the dividend. But then you also, beyond all of that, you have the huge upside of potentially a major acquisition, like they have done in the past. And eventually, we believe that major acquisition is going to happen because it's something that the company has done successfully. You just don't know where to time it. So Exchange is a company that we are continuing to like for people that would hold it for the next 2 to 3 years at least.
You know what? This is put the Dunn's cap on my head here because I never asked you what they did because I'm familiar with the company thanks to your recommendation. Tell people very quickly what it does.
Okay, so it's mostly a specialty aviation company. So they've got several subsidiaries in that area, and they do a wide range of different things. They do airborne surveillance for governments. They do supply of remote communities. They do some search and rescue, some firefighting, some aviation training, aftermarket product part sales and whatnot. So there's a lot of different components in the business, and it's one of those things that you cannot just easily categorize into an industry segment. I mean, generally, if somebody says, "What do you think about aviation?" It's not normally an industry that I love, but it's with Exchange, they're really what I would consider a special situation company. They are in aviation, but in a very unique way. And their growth profile has not been so dependent on just growth in the overall economy. Like I said, we have lackluster growth overall in the economy right now, yet Exchange is able to produce very solid organic growth. So definitely a special situation business.
Yeah, it's going to be fascinating. I look forward to hearing you. And again, we're doing something special this year at the World Outlook Conference. As the conference starts February 3rd, we're going to start this at 1 o'clock, February 3rd. We're doing a whole section on searching for yield. Aaron Dunn will be there. You'll get a chance. And this is one of the things I love about the Outlook. Go talk to him in person. Of course, I'm looking forward to the presentation, too, but go talk to him in person. Aaron, I look forward to seeing you there and appreciate you finding time this weekend for us.
Thank you very much, Michael, and we're looking forward to it. And we really honestly think that is one of the best conferences that we've ever been to, and we've been to a lot of conferences. We love the conversations there, so absolutely come and talk to us.
Great stuff. You can find them at keystocks.com. It's Keystone Financial, but try them at www.keystocks.com. Coming up, I got a shocking stat for you. Just a reminder, though, talked about it this week. The list of people, did you know that Jim Dines is also going to be with us there at the Outlook Conference? Martin Armstrong's going to be with us, James Thorne, Mark Leibovit. The list is a long one. Ozzie Jurek, of course, who's going to be with me in a minute, and he's going to be issuing a sell recommendation for a specific type of real estate, and he'll tell us what that is when we come back. But I got a shocking stat first, and this is one that, again, one of those that's just a classic. I read the numbers and I went, wow. Well, I'll tell you which one that one is when we come right back here. You're listening to Money Talks, and of course on the Money Talks Network. Coming up, as I said, Ozzie Jurek has got a new sell recommendation, specific type of real estate. I'll let you in on what that is. Victor Adair is chomping at the bit live at the trading desk. I got some questions for him, and I hope you stay tuned for a Goofy Award. I think it's important, and you'll either hate it or you'll say, thank God somebody finally said it. That's my Goofy coming up before we're done here. But right now it's time for the shocking stat of the week. Kind of interesting, by the way. Do you remember when President Obama obviously took office, 2008? I think it was right away, 2009. He was awarded the Nobel Peace Prize for, I think in quotes, extraordinary efforts to strengthen international diplomacy and cooperation between people, end of quote. At the time, it was a bit controversial, simply because not much had happened. A little bit early to be doing that for him, and we're time to talk legacy right now with President Obama. And look, I'm not trying to make a political statement here. I just thought this stat alone was just shocking. According to an analysis of Defense Department data from the Council on Foreign Relations, that's a nonpartisan think tank, President Obama will depart the White House having dropped 26,171 bombs on foreign countries around the world last year alone. That's over 3,000 more than 2015 when they look at that. But as I say, he started with the Nobel Peace Prize. He got that Pentagon's Distinguished Public Service Medal. And this is a quote from Rand Paul, who said, "Sounds about right for a president who bombed 7 nations and became the first president in U.S. history to be at war every single day of his 8-year administration. Did you know that? That's kind of interesting. At war every single day during his 8-year administration, but that didn't happen. World War I, World War II, none of that stuff. But it's kind of ironic given that he had received the Nobel Peace Prize. But I'm not blaming President Obama on that. I'm saying the world is far more complicated. It's not as simple as saying, I'll just close Guantanamo Bay, I'll do this, I'll do that. All of those simplistic things, that's really the problem. The world is far more complicated than the rhetoric that we get treated to on a regular basis. But still, I was blown away when I read the number. 26,171 bombs on foreign countries last year alone. I'll take a break, I'll come back. Let's find out what Ozzie Jurek is thinking about selling. Coming up, I've got a great Goofy Award for you, so stay with us. But right now, I got to get Ozzie Jurek in here. Ozzie, I want to get right to it. I know that you've issued a new sell signal for a specific type of real estate. Can you elaborate for us? Give us what you're talking about.
Well, I think we have so much interest in foreign investors, and it hit the news Canada-wide. And when you could consider our farmland in BC, it's sort of a very popular investment vehicle, and we have the highest land values, and yet we're the only Western provinces that has no restrictions on farmland purchases by foreigners. In fact, Saskatchewan, as of January 1, tightened its restrictions not only on foreigners, but they passed amendments to its Farm Security Act to clarify who can and who cannot own farmland. So pension plans, administrators of pension plan assets, trust ineligible, are ineligible. Easy for me.
Ineligible. That's easy for you with your background to say. Yeah.
People say I'm the only Canadian who doesn't speak either one of the official languages. So there you go. So, but the point is that all financing now must be approved through a financial institution registered to do business in Canada. And it all started when the Canadian Pension Plan bought some 115,000 acres in 2014. Anyways, in Saskatchewan, entities which are 100% Canadian-owned, are not publicly traded, can do it, but nobody else, and non-Canadian citizens can only own up to 10 acres. So fast forward to BC, we got the highest prices. We're 10 times the price in the prairies, and we don't have any restrictions. So I think it'll probably be a nice issue for the government to put into the election. So if you're an investor in BC right now and holding farmland, you might think about it very hard, because if you have fewer buyers, then maybe right now the highest prices you've seen for a while.
Well, the other thing you're just pointing out is there's a brand new risk, and that shouldn't be, we're no strangers to that. I mean, look at what the real estate market has done. You're talking about British Columbia, so let's bring it out there. Let's look what the real estate, I call it the big three. They raise the property purchase tax on anything selling over $2 million. They bring in the foreign buyers tax, and then you got the raft of new mortgage eligibility rules, and presto, it's a recipe for a very slow market in Greater Vancouver. And so we understand the possibility of a government-related risk, and as you say, they've just done this in Saskatchewan.
Yeah, and the thing is that, you can argue either way, and I could come down either way of the argument, because we also have Chinese buyers buying tens of thousands of acres near Vanderhoof and exporting the wheat there. But I'm only interested in, and my newsletter and my whole being is interested in investors in real estate. And if you're an investor, you might really want to think hard as to what you're going to do with your farmland that you have now. And so, I'm not negative on the future, but I think we will, like you said, we will probably have a down year, but overall, real estate is the place to be as far as I'm concerned.
Okay, I'm changing gears now, new subject. We're just talking with Aaron Dunn about the new section we've got at the World Outlook on the search for yield. You'll be speaking, keynote speaking there. Just give me a couple very quick ones. What are the best suburbs that you found, and I'm talking about for investors, the kind of yield you can get?
Yeah, and at the Outlook Conference, we're going to talk about the 5 best cities in Canada and the U.S. and the 5 best suburbs, the 5 best retirement towns. Well, you might be interested to know that I don't care what happens to the market. I like New Westminster. The vacancy rate is 1%. The average two-bedroom rental income is $1,350. The average per-door cost for multifamily rentals is $154,000. We like it. Surrey we like. 1,200 people a month are coming to Surrey. Michael, we had over 50,000 people come to BC last year. That's an absolute record. I'm going to talk about that as well. But in Surrey, you can buy brand new stuff between $180 and $250 and rent it for $1,200 to $1,400. That's going to cash flow all the time. It'll be a good investment.
Okay, so you're going to talk more about that at the Outlook Conference. Another one, let me throw the curveball at you, and it's just because I was reading this little story and I was thinking about you, Ozzy, about the best places to retire. Not that I'm suggesting you should retire. Give us a couple of the best places to retire in the world.
Well, we always do that at the Outlook Conference. It's a bit of fun, but it's really, really important. I mean, look, you can go to Portugal and to Spain and get a visa, what they call a golden visa, at the same time with your property purchase of $400,000. So what a place to retire. But what we're doing this year, we not give you just the best, we also give you the cheapest. And I'll give you a teaser. For instance, if you go to Spain, we used to say Barcelona. Now we say Valencia because it's the cheapest. And we got a brand new one in Vietnam. Listen to this, $300 a month rent, $5 for a meal, $50 a month utility, and a beer is only $1. My God, go to Nha Trang in Vietnam and retire there, and it's the cheapest place.
I'm absolutely impressed that you haven't retired there already, given it's $1 beer. Ozzy, I look forward to seeing you at the World Outlook Conference. You'll be elaborating on all of that, but I love that kind of stuff. And by the way, I think if we started a GoFundMe page for me to retire, we'd raise a lot of money to get rid of me on the air. So let's keep that in mind for the Outlook, too. Ozzy, go out and have a great weekend.
Thank you, Lark. Bye-bye.
I'm going to take a break. I'll come back. I got Victor Adair. I got to ask him two subjects with Victor. I got to start with oil, and I got to ask him about that Trump effect we've heard so much about. Plus, I got a goofy award I want you to stay with me for. All of that coming your way on the Money Talks Network. I got a goofy award coming up for you. I hope you stay with me for that. It's going to be good. But right now, let me get Victor Adair in here. I got some questions for him. Vic, I want to start with the big question. We hear all this Trump effect stuff, obviously, because we had that monster move after the election. What was it? The second biggest move since the biggest move rather since Dwight Eisenhower in 1952 on a wide variety of things. But it seems to have lost steam. As rallies do. But what do you make of all that?
I kind of break it into two parts. In the 6 weeks immediately following the Trump surprise win in the election, we had a strong move. In other words, interest rates in the United States moved sharply higher. The U.S. dollar moved up about 4%, which is a pretty good move. And certainly U.S. stocks and stocks around the world jumped higher as well. The gold price fell. And then once we hit the 15th of December, that was kind of my key date. That was the day interest rates peaked out and started to turn. And I think that interest rates, American interest rates, are kind of key to all those other things. Key to what the dollar's doing, key to what the stocks are doing, key to what gold is doing, that sort of thing. The U.S. interest rates peaked on the December 15th and started to go the other way. So the power of they call it the Trump effect, was very strong for 6 weeks, and then it's kind of petered out here in the last month.
But again, what do you make? How do you use that now as a trader? Has the market changed for you? Have you changed positions because of this? Did you take profits? And that's one of the things the mainstream media regularly gets wrong. They forget it's not really a change in the environment. People simply made enough money and they took the money off the table.
Yeah, there's two things. There's the things you do and the things you don't do. Now, the acceleration of the U.S. dollar on Trump's election, I got left behind on it. I'd really gone to the sidelines ahead of the election because I had no idea how to handicap it or really what was going to come along. So I missed that, and I just didn't chase it. And at this point, I'm happy I have, because the last 3 weeks here in a row, the U.S. dollar has closed lower. We did before, mid-December or thereabouts, we covered our short position in gold. Mid-December, we started selling out-of-the-money puts on the bond market. In other words, we thought the rise in interest rates had been too strong and was going to reverse, and that trade has worked for us. As I mentioned last week, a trade that we put on that has not worked, we've been losing money on, is I was looking for the U.S. stock market to roll over. We bought some out-of-the-money puts because as time goes by, the options lose value. We're losing money on that trade. So, and then one other thing, I guess, the Japanese yen fell 15% from the overnight extremes when Trump was elected to where it was in the middle of December. I just thought that had gone way too far, and we started to sell option positions against that, and that's worked in our favor.
Hey, we've got just a minute or two left here, but I got to get, can we just elaborate a bit on oil for me?
To get right to the meat of it, I mean, the thing that really stands out for me with crude oil is there is huge speculative positions in the oil market. Let me put it this way. We call the futures markets paper crude. The speculators have bought $45 billion worth of crude oil. Who sold it to them? The commercials. And commercials are people who are in the business of producing, refining, marketing crude oil. We generally think producers in any in any market are smarter than the speculators. Maybe sometimes they're wrong, but my thought is, and I'm going to stay with the Joseph Schachter view, that the supply-demand inventory story is still bearish on crude. And this is the big if, and this is the trading if for some reason the price of crude starts to decline from here, those speculators will start to sell, just like the speculators in gold. We got this huge gold position post-Brexit. As gold started to come down, those speculators sold out their positions and helped drive down the price of gold. We think something similar could happen in crude oil, so we've got a net short position in crude.
Yeah, it's going to be fascinating. And, I mean, every year you need that you see what happens in January, but that's why I'm looking forward to the World Outlook Conference, and you're going to certainly be there. And it's a great chance. I mean, Victor's a lovely person, and he's very affable, so it's a great chance to come and chat with him. And so I look forward to seeing you there myself, Vic.
Mike, I'm looking forward to seeing you, too, and I hope you're doing a little dance, something, an improvement over what you were doing last year.
Yeah, well, oh my gosh. We've had 2016, not my favorite time. Vic, I look forward to seeing you. We'll talk to you then.
Okay, Mike, thanks.
Great stuff. My thanks to Victor, of course, but all our guests today. Great stuff from everybody. A reminder, though, that Money Talks is brought to you by Solera Club. Solera Club is a royalty-based investment, meaning you get paid first. That's what they mean when they say that. It's a stream of income that you are first in line for. There are no fees attached to it, and it's in the tech sector. And now if you want more information, you got to go to soleraclub.com. Time now for this week's Goofy Award. Well, this week we got treated to a celebrity doubleheader, otherwise known as the Narcissist Daily Double. We got Jane Fonda talking about the oil sands, Meryl Streep talking about Donald Trump. Now, I know the temptation for thinking people everywhere, the operative word being thinking, is to ask, who gives a flying fig? But the answer is obvious. The media. Judging by the coverage, they're both monster stories. I mean, my God, a celebrity speaks, and we're all supposed to listen. Maybe the news directors could tell me how far down that celebrity ladder they're willing to go before they stop genuflecting. I mean, for example, what if Henry Winkler or Suzanne Summers or Gary Coleman comes up to the oil sands? Does that still get all the coverage? Or do they have to be Oscar winners like Fonda or Grammy winners like Neil Young? And is there any subject that won't be covered if an A-list celebrity does talk about it? Come on, we've had Sean Penn and Danny DeVito talking about the Israeli-Palestinian situation. We had Bono, Russell Brand, with their own childlike understanding of economics, but man, it gets coverage. Leonardo DiCaprio sits on his yacht talking about climate change. Got to get the coverage. And now Meryl Streep joins a long list of celebrities decrying Donald Trump. I mean, is there any subject, if an A-lister talks about it, we won't get? But one thing is certain, the media loves it. At least until a celebrity they don't like becomes president of the U.S. Now, I'm not sure whether to categorize all this as fake news or just straight-up BS, or maybe it's just good old-fashioned lazy journalism. But it used to be, if you remember, celebrity coverage was confined to People magazine, or there was that part of the entertainment section of the newspaper. But now, laughably, it's considered, in quotes, serious news, headline material. Now, I have no idea if the journalists and news directors who put that kind of stuff out are embarrassed, but they should be. They are frontline soldiers in the dumbing down of national debates. But here's the part you should know, and no one talks about it. Breathlessly covering Jane Fonda's view on the oil sands or Meryl Streep's unoriginal diatribe on Donald Trump is an insult to you personally. Whether you agree with them or not, it's still an insult to you. Why? Because the premise behind all the coverage is that celebrities are more important than the rest of us. After all, you may just work in an office, yuck, or do construction, ugh, or sell things, or provide a service. They've made hit records. They were in television series, maybe directed a movie like James Cameron, or starred in Barbarella. Boy, that's the criteria. Some idiot stands up who happened to be in the entertainment business and speaks, and we're all supposed to applaud. Well, I'm not. Media is, but I'm not. That's why it's this week's Goofy Award. And as you know, just a reminder, coming up, we've got the World Outlook Conference. I should have been more specific about this. Go to moneytalks.net. Click on tickets. I'm not sure if there's how many are left, but a reminder also that you can bring a student if you fully pay. That's one of the things I'm big and on about. And boy, I can't tell you how important I think that exposure is. They're going to have, and I wrote a note about this to people this week. I mean, really, the chance to hear someone like Martin Armstrong talk about changing a worldview that they are not hearing anywhere else. But we heard Aaron Dunn earlier. Our job is also to have the ticket pay for itself many times over. We've been lucky. It's not a guarantee that what will happen this year or the years subsequent to this, but in the past, that's absolutely been the case. And, of course, we aspire to doing that again. That's why I bring in good people. I mean, I vet every one of them that comes in and speaks on that main stage. We're talking, Jeff Olin, by the way, is coming too, and I'm looking forward to that, his take on real estate. There's so much at that conference, a chance for you to personally talk to a lot of the analysts. That's what I like about it. But the other thing is, hey, go to moneytalks.net. You get the business comment every day. Click on, get some latest research. There's so much there. I hope you join us for that. But in the meantime, I want you to just go out and have a terrific weekend. I do appreciate you listening.